Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the WorryFree Retirement with your host, the author and creator of the WorryFree Retirement himself, Tony Walker.
Well, hello and welcome to the WorryFree Retirement. I am Tony Walker, the author and creator of the WorryFree Retirement, and you are watching the only show in the country dedicated to helping savers worry less about money. So hopefully over the next roughly 28-30 minutes, you're going to see some information that some of you are not used to seeing. We're going to be talking about more details on fixed annuities, the new indexed annuities, the hybrid annuities, as I like to call them, the pros and cons of those contracts and how you figure the crediting methods, and how you have to watch out for these crediting methods and understanding them. We're going to be talking about the taxation of Social Security, which is really an important topic and one that gets overlooked in the planning process for retirees. And then we're going to talk a little bit about the stock market and why I have some concerns right now in terms of why we may be at its peak. And now, as I always say in the book, don't follow the herd. People tend to be gravitating towards the stock market. It's looking awful good, but you savers out there need to be careful, and I'll be covering some articles that deal with this very issue. As well, I always like to point to the 3 books I've authored. If you'd like to go on Amazon.com, all these books are available. The latest book, The 3 Personalities of Money, is also available in an ebook. The WorryFree Retirement, we have Don't Follow the Herd, and of course the 3 Personalities of Money. You can also check out these books at TonyWalkerFinancial.com. I would say too, for those of you who are trying to understand more about my concept with the saver, investor, and speculator personalities, there's a really cool test, in case you haven't heard about it, that we created just for you. All you do is go to 3personalities.com and you click on the Take the Test tab. And when you click on that Take That Test tab, it only takes about 5 minutes. You're going to fill out some very brief questions, answer those questions, and then it's going to immediately tell you whether your predominant personality is a saver, investor, or speculator. And then after you complete that test, we would encourage you to contact me. Of course, if you're outside the Southern Kentucky viewing area, if you're in the Southern Kentucky viewing area, you can contact me directly. But if you're outside that area, you can go down to Find an Advisor in your area, and we will be glad to put you in touch with somebody in your area that can talk to you at no cost or obligation about your financial personality and which products and services are more tailor-made towards you. Well, of course, the show wouldn't be complete without the introduction of America's favorite financial sidekick, Mr. Aaron Orander. Aaron, how's it going, partner?
Hey, Tony. It's always a pleasure to be here, be with you, talk about things.
Look forward to seeing you each Monday when we record this. Of course, we record this in Louisville, Kentucky, and today is actually Martin Luther King, the day we celebrate Martin Luther King Day. And I thought I would kind of dress up just a tad. You know, usually I have the pullover vest with the Tony Walker logo. I kidded around about maybe you spoofing up a little bit, and here you are with the tie showing up. So I got my what's the guy's name? Mr. Rogers. I got my Mr. Rogers vest on. You got your tie on, so we're probably throwing the audience off a little bit here. How's your weekend? I know you did something with your boy this weekend. What'd y'all do?
As always, yeah, we it was kind of a low-key weekend. We just went and got some ice cream. You know, we're in the potty training stage right now, so Is that how you potty train them nowadays? You take them to get ice cream? Is this a new theory?
I don't know. There's a lot of parenting things.
It worked this weekend.
All right. Bribe them with ice cream.
Yeah, and Skittles.
Skittles.
Skittles. He's a big Skittles fan.
Well, I got one that's 18 years old and still likes Skittles.
Okay.
We lost our oldest dog, and now we're thinking about another dog, and I can't believe I'm looking at I can't even believe I'm getting ready to say this on air. My youngest is wanting to consider, you ready for this? Now, we got 3 dogs already, a Great Dane. So we went over and looked. I've never seen one in person. I said, I'll tell you what, I'll go see one in person. So we went to this breeder, and I saw the dad of this pup. I've never seen anything like it. I've never really been around a Great Dane. He said, well, he's about 180 pounds. His daddy was 200. I'm thinking, this is crazy. I mean, what are we going to do?
It's like a small horse, you know? It's like
I don't know. So anyway, crazy stuff. Hey, I want to ask you something. Let's get down to business here.
All right.
All right, you're a little on the younger side. I know you came out of the TV background. You've been around me a little bit here, coming to workshops. You're trying to learn about investing. If I were to ask you, Aaron, what do you think of the stock market? What's the first thing that comes to your mind when you just think of the stock market? What would you say?
Probably the first thing I think of is the concept of a roller coaster. You know, you can stand on the ground, you can see the roller coaster, you can see the ups and downs and everything, but you don't really know what it feels like until you actually get on it. I'd say the only difference is when you're going down a roller coaster, people tend to, you know, kind of be excited and throw their hands up, whereas in the stock market, if you're going down, people kind of throw their hands up for a different reason.
Very good. Well, so as you're watching the market, I know you kind of keep an eye on it a little bit. You see the TV and all that stuff. I mean, do you think the market, and again, forget what I've said on this show, but I mean, does it seem like the market's too high, too low? Do you really know how the market's even valued or how they come up with these numbers like the Dow and the S&P?
I'll be honest with you, I don't really know how they come up with the numbers. You know, I'm just like every other American. I'll have the news on and they've got everybody's, I guess, points or whatever you call them scrolling across, and, you know, oh, this company was up 14, that company went down 3 points. I don't really understand how those fluctuate. I don't really understand it. I don't know if it's from consumers, whether they buy from the company or don't buy from the company, whether the company has some issues. I don't really know. I don't really understand how the points fluctuate.
If I told you, let's talk about Vegas, and I wouldn't want to say Wall Street's just like Vegas, but when you go to Vegas, I think nobody's naive enough to think that when you go to Vegas, the house is controlling the rules, though. You'd agree with that, wouldn't you? And the house probably can control who makes money and who doesn't, right? I mean, that seems logical. I mean, they're building all these big buildings, and people are walking away from Vegas. Most of them aren't shouting for joy, so somebody's winning. I don't think it's the consumer. On the Elmo there, I want to, let's see, grab this article. This says stock buybacks, a warning signal. Let's go to the Elmo. I want to show you something here. Let me just read this. And again, this is more proof, folks, that, and again, there's nothing wrong with Wall Street, or as I like to say, Wally World, but you've got to understand most people don't really understand how the market works. They don't understand share prices. They don't understand earnings. Look at what's happening here. I want to try to explain this. Stock buybacks, a warning signal. Share repurchases in 2013 topped $700 billion a year ended. What's happening here, this article is talking about, is companies, Aaron, and just leave that article up there for folks to read. Companies, Aaron, are going and they're using their own money, or worse yet, they're borrowing money to buy back shares and put those shares back in the company coffers. Now, why would they do that? And you don't have to, if you don't know, just say, I don't know.
Educated guess, I'd say to make their points go up, I guess.
Exactly. It goes up, but how it goes up. Remember we talked about fair market value the other day. How that works is if I'm a company and I buy back shares and I put it back in I retain those shares, that means there's fewer shares out to buy, right? Because I took some of them back.
Right.
And that makes possibly the earnings per share, since there's fewer shares, it's just like a number of houses here in Louisville, Kentucky. If fewer and fewer houses are on the market, the fair market value probably goes up because there's demand for them, right?
Right.
So the same thing happens with stock market valuation. So what people are saying here, some of the people are saying this could be a bad thing because back in 07, the same thing happened. Right before the 08 crash, companies were buying back a lot of their shares, which made the valuations go up, the price went up, and this could happen again. There's one other, here's another article. Let's go to this one that says, what will cause the next correction? Okay. And if you want to zoom in here, let's go back to the Elmo. You can zoom in on that yellow highlight there. This is came out of Investment News January 6th. Now again, folks, I don't know the market will go up or go down. I just know it will go up and go down. It always does. We just don't know when. But look at this. This person says if we don't get a re-acceleration in growth now that all the government uncertainty is out of the way, this person says, I think that might cause a market correction because people have largely marked up their growth estimates, not only in the U.S., but globally. Okay, thank you. So, Aaron, what it's saying here, and folks, what we're trying to say is when share prices get this high, which they are very high right now, there has to be a reason for them going up. There has to be a demand. And if that demand is artificial, which I believe some of it is, if we are artificially, companies buying back shares, making the demand go up and the price artificially high, if the government, which has been injecting all this money, printing money, making the shares go up. And that's what this article is saying. Now that the government's going to say they're going to quit buying all these bonds and injecting money, what's really going to happen? So folks, here's the lesson for you. If you're a saver out there, we're going to come back with some ideas for you. If you're a saver out there, you're either in the market and you've been enjoying this high. Remember, as Aaron said, you don't have any gains locked in yet. You are still on that roller coaster. So when we return, I'm going to show you some ideas that can help you lock in those gains and put you on a road to a worry-free retirement. If you're a saver, you're going to want to stay tuned for this. I'm Tony Walker. We'll be right back. How would you like to find a trusted advisor in your area who practices and preaches the same safe money solutions that I speak of on this program? Well, you can by simply logging on to TonyWalkerFinancial.com and clicking on the Find an Advisor link. Once there, just fill out the confidential profile and submit it. This free service is available to savers who are serious about safeguarding their money. So what are you waiting for? Stop worrying and log on to TonyWalkerFinancial.com. All right, welcome back to the Worry-Free Retirement. I'm Tony Walker, and we always encourage your viewer emails. It's very easy to email us a question. You just go to Tony@TonyWalkerFinancial.com, or you can go to TonyWalkerFinancial.com, click on the Contact Tony, and send us your question. We're always happy to try to answer those. And if I can't answer them, maybe Aaron can. No, just teasing. All right, Tony. If I roll over my company-sponsored 401k, currently this viewer says it's with Fidelity. By the way, when we're talking about terms, Fidelity, Vanguard, Merrill Lynch, if you're with a 401k, it's good to know that whoever has your 401k and manages it, they're called a custodian. You need to know this because when you start rolling things out, you got to understand the vernacular. So in this case, the custodian of the funds is Fidelity. They say, do I have to roll over the entire amount into a tax-free annuity? Obviously, they've seen the show and they've got some interest in putting that 401k into an IRA annuity. Or can I roll over 99% of it and leave just a few dollars in the 401k? The reason I'm asking is that I'm trying to, let's go to the next page there, determine if I could keep the 401k as long as I'm employed at this particular employer, get the company match, and this would allow me to get the company match for another 8 months. Very good question, thank you. So apparently what's happening is this person is thinking about retiring in about 8 months. This comes up a lot when we're dealing with people at or near retirement. They want to continue to contribute to the 401k. They want to get the match, but what they're worried about is what I call the old money, that money that's sitting in the 401k. You know, you're getting ready to retire. What if we had a huge market correction? You're sitting around with your money exposed to the market over here at Fidelity. Well, you could obviously put it in a stable value or money market fund, but some people, when they're doing planning, might be ready, and we'll talk about this more, to move that money into what we call a fixed indexed annuity. I'm going to show you the beauty of these. So in that example, in most cases, especially if you're over the age of 59 and a half, you have to check with your custodian on this, and they can look up the plan document and tell you, but you can roll that money out and still leave the plan set up. That way you could continue to contribute, but roll out the old money to somebody like us who can put it in an IRA annuity, or we can put it in other funds as well. I'm a registered investment advisor. I can pretty much do anything you want to do. The key is, though, you want to roll it out so you can get a game plan around your money. Most custodians are not going to do that. Your 401k administrator is not going to do that. Your HR person is not going to do that. You need a retirement specialist who can take that money, set up a game plan, and then so you can enjoy that money for the rest of your life. That's the beauty of the Worry-Free Retirement. Now let me show you something here. I want to talk about the stock market because in order to explain index annuities, sometimes I need to go over this again and again and again. Aaron has talked about this because, you know, it's like I'm used to doing this every day. It's like anything. When you see something every day, you take it for granted. When you're out here and you're a consumer and you're bombarded with financial messages, we have to understand how the market works and the risk associated with being in the stock market. Now, folks, this is not to scale. I'm just showing you an example. Let's say this represents the stock market. So we're going to take 2002. This was after 9/11. You know, we had a downturn there, and gradually it started going up. And then as we saw, we just talked about this earlier, everything seemed to be going great guns. We get up to around 2007. I think the Dow then was around 14,000, something like that. And it's funny, I always ask people, did your stockbroker, did Merrill Lynch, Fidelity, or did anybody call you and say, hey, we better get out, the market's awful high? And I bet most of you watching say, hey, I never got that phone call. We just assumed it would go up forever. And of course, what happened? I'll use red for effect here. you know, that market over the next couple of years really went tumbling down. Of course, now, just like any roller coaster, we're back up here. Now we're up at 16,000 range or whatever, and the question is begged to be offered again to you. Are we at a high? Do you need to take some winnings off the table? In my opinion, especially if you're a saver, if you've been on this ride, I believe it's a good time to get some of that money pulled out and locked in. Now, as you know, I'm a big fan of indexed annuities. Managed Money in the 90s did the same thing. After 9/11, decided to try to find a product for savers that could help them worry less about their money during retirement, and the fixed annuity fit the bill. Since 9/11, our firm has written over 1,500 of these contracts, totaling over $200 million of protection for our clients. So I know these products well. By the way, if you do go to the website to find an advisor, if you're outside Southern Kentucky, these folks know this product very well too. If you're interested in exploring more about fixed indexed annuities, all you do is go down there and click on that button that says Find an Advisor in your area, and they'll be happy to help you. Okay, so Tony, what's the gist of these products? How do they work? They're quite ingenious, actually, and they came out in the late 90s, and that's why nobody really cared anything about them, because in the late 90s the market was doing so well. So what happens with an indexed annuity is it is going to take a year-by-year look, let's just imagine these are years, at what the market's doing. So when the market goes up, we may have to zoom in there, it's pretty close to follow my green. The indexed in the market, these are with insurance companies, remember this is annuity, will pay a portion of the market. You see how that works? All right, now here's the beauty though. When the market goes down, this is called a new floor, all right? So when the market goes down, if you've got an indexed annuity, Dennis, you might zoom in just a tad more there, or Matt, excuse me, bringing it just a little tighter here. As you'll notice, you have this new floor. You seeing that over there, Aaron?
Yes.
Okay, so in other words, while the market is going down and you're losing sleep, this has a new floor. Now here's where this product is ingenious. As the market goes up, you're not going to get all the market, Aaron, but you're going to get a portion of it. That's looking pretty good, isn't it?
Absolutely.
Now again, you might say, well, heck, dadgummit, why wasn't I in the market? I would have gotten all this. Here's the problem. When the market goes down, you have another new floor, so you do not lose again. It's sounding pretty good, isn't it? Especially if you're conservative. Now, here we go again. Market starts creeping up. We're coming back up again, and then if the market goes down here, we have another new floor. So folks, if you're a saver, and if you're looking at this graph here, and you're seeing this stair-step effect rather than this up and down roller coaster that Aaron talked about, and you're saying, this sounds like me, this sounds like something I would want, you need to contact us immediately. We're specialists in this area. We can show you how to choose the right type of annuity. We're going to talk about crediting methods in our next segment. Or if you're outside the Southern Kentucky area and you can't visit with me personally, we can put you in touch with somebody. There's the phone number on the screen. There's the website to contact somebody. Don't delay on this. If you're concerned about the stock market and you're getting the EBGBs right now, take action. There are things you can do. You don't have to put your money at risk. There are things you can do to be worry-free about your money. Well, I'm Tony Walker. We'll be right back. We're going to talk about crediting methods of index annuities and why you need to understand these as well. Stay tuned. For nearly 30 years, I've made it my life's work to help savers worry less about money. And now I invite you to personally contact me to discuss your situation to see if I can help you. It's very easy. You just log on to TonyWalkerFinancial.com and click on the Meet with Tony link. Or if you like, you can attend one of my free financial workshops. As always, there's never any cost or obligation to meet and discuss your situation in private. So what are you waiting for? Log on to TonyWalkerFinancial.com. And welcome back. Got another email question. Tony, my husband and I are pretty good about saving both in a retirement fund and also a general savings for emergencies. However, we have not really saved for college expenses, and our first child will be heading off for college next fall. Would it be better to take out a loan to pay for school or use some of our retirement funds? You know, we don't really do college planning in our office, but when we're working with retirees, this comes up a lot. You have to remember one thing. I learned this years ago, and at first it took me back. Paying for college, listen to this, I know you're trying to invest in your child, but any way you slice it, it's an expense. So the point with expenses is what we have to figure out is what's the cheapest way to cover the expense. Now, if we took it out of the retirement fund, which you could do it, you could borrow it from a 401k. The problem with that is you're limited on how much you can borrow, and then the government tells you when you can pay it back. Don't you love the government always telling you what you got to do with your own money? And what happens when you make that loan, all right, you also lose the gain that could have been there. So if you had maybe pulled that money out of the market and borrowed the money from yourself, you lost all the gain. Plus, when you pay it back, you got to pay it back with after-tax dollars. So that's not the best thing. But you don't want to go out and buy borrow against credit cards and the like. Here's one area that you might want to consider as well. If you don't have the funds available, consider a home equity line of credit. Usually the interest rates are lower. The equity in your home's a dead asset anyway, so even if you're borrowing against it, you're not robbing from Peter to pay Paul like you might be in the 401k. Finally, the best thing to do before you do anything like that, get with a retirement specialist. Look at the whole gamut of all of your assets before you make a final decision on something like that. All right, what the heck are these crediting methods, and how do these insurance companies pull this off? Well, I've got to tell you, there's two different ways to look at crediting methods. There's a whole lot of things going on, but let me give you an example of what happens with an indexed annuity and how they're crediting this market gain without any risk. The two most popular are called point-to-point annual, and we'll look at point-to-point monthly in a second. All right, how do these work? Let's just say, Aaron, I'll use you as the guinea pig. You just bought an indexed annuity, and it was issued on February 1st of this year. You with me? And we'll just say, so I can do the math real quick, the S&P is the index we're going to use. It's at 1,000. All right. Now, let's say that the market, we'll just say all year we're watching it, they're tracking it, and at the last minute, the market goes up, and the S&P, Aaron, 1 year from today, you with me so far?
Yep.
It was at 1,000. It's now at 1,200, all right? And that's a 20% gain. Now, quiz time. Will you get the entire 20%?
No.
No. So let's say this was an S&P annual with a cap of 5%. How much do you think you're going to make?
Are you going to make 5?
5%.
Yeah.
So if you put in 100,000, now at the end of the year, you'd have $105,000. The person in the market would have had 120, but what the person in the market doesn't realize is what? Is that really locked in, or could they lose that money?
They could lose that all if it goes down the
There
last
you go.
day.
Whereas you're locked in with a new floor. That's called the annual point-to-point. So if a person has an annual point-to-point crediting method, it doesn't matter what happens in here. Does that make sense? They're going to look at the S&P here at this point and this point. Anything goes on here, it doesn't matter. Is that kind of making sense? All right. Let's slide over here. This is called the monthly point-to-point. All right. So let's imagine, same thing. We have the S&P at 1,000 on February 1st, and then the S&P is going to end up at 1,200. Now, this monthly point-to-point is what's called a monthly point-to-point cap. Let me try to explain this. So we're going to try to duplicate the same market. Let's say it's gyrating and goes way up. And so you go from 1,000 to 1,200, and your initial reaction is, I made money, correct?
Absolutely.
It may not be the case. See, folks, you've got to watch this. Depending on the crediting method, and I'm not saying one's bad or good, it doesn't matter. But what happens is we have advisors out there right now that they'll talk about this crediting method, and what they'll do, they'll say, you could make as high as 24% on an indexed annuity. Now, that could happen, but it's unlikely. Where they're getting that from is they're taking 12 months times 2% equals 24%. Well, folks, that's just, it's wrong to build that false assumption into your premise. It could, but it's very, very unlikely. So why is it so difficult to make 24% even though the market went up 20%, let's say, or went up 40%? Because with the monthly point-to-point, what the insurance company is doing, they're dividing this up by 12. They're only paying you a 2% cap each month. But what happens if we have a big downturn here one month, let's say it went down 10%, Aaron, they're going to subtract that whole 10% out. So yeah, that doesn't look good. So if you had 2, 2, 2, that's the most you can make on the upside, but you had a big negative 10, that could bring it way down. So we have to be careful with this, folks. Whenever you're looking at indexed annuities, make sure the representative is discussing the different crediting methods. A lot of times what I'll do is I still go with the monthly point-to-point. We're starting to go with that more and more because what's happened over the years since we've been using these, some of the products, the caps on what we call the annual point-to-point are dropping. So by the way, if this is starting to seem confusing, one thing we've got on the website that can help you a little bit, and we cover this, it's a booklet I wrote. If you go up to the top of the website at TonyWalkerFinancial.com, you'll see an icon that says Annuities 101. If you could click on that, please. It'll take you to a landing page, and there's lots of resources I've written regarding annuities. One of the booklets we have on there is a free download. It's called The Biggest Misconceptions of Annuities. There it is right there, the 10 biggest misconceptions about annuities. This is something I wrote several years ago. Quite frankly, I need to update it to include income riders, but I think it's one of the better books written in layman's terms that deals with the different types of annuities, how index annuities work, how the crediting methods work, etc. Another great book you can get is Don't Follow the Herd. Don't Follow the Herd is a book that I wrote, and it even has some of this graphically laid out. It uses great analogies so you can understand some of the concepts of index annuities and whether an index annuity might be right for you. Again, that's Don't Follow the Herd. You can get that off our website, but the best place to probably order it in either hardcover or ebook is on Amazon.com. Well, by the way, we're going to be running out of time here in a minute. I want to explain something real quick. Show the graph, Aaron, on the Elmo, if you would, please, of the Social Security taxation. Next week, we're going to be talking about this little graph. This is a huge issue, folks. Many of you are getting ready to take Social Security or taking Social Security, and you have no idea how the taxes work. We're going to come back with a few closing comments on this. I'm Tony Walker with the Worry-Free Retirement. You stay tuned. I'll be right back. How would you like to find a trusted advisor in your area who practices and preaches the same safe money solutions that I speak of on this program? Well, you can by simply logging on to TonyWalkerFinancial.com and clicking on the Find an Advisor link. Once there, just fill out the confidential profile and submit it. This free service is available to savers who are serious about safeguarding their money. So what are you waiting for? Stop worrying and log on to TonyWalkerFinancial.com. Well, I hope you've enjoyed today's show. We're about out of time. Keep in mind next week I'm going to cover some details on the Social Security taxation and also fees on annuities. In the meantime, feel free to go to our website at TonyWalkerFinancial.com. There's lots of great resources and things you can check out there. Until next time, I'm Tony Walker saying you make it a good day.
You've been watching the Worry-Free Retirement with financial advisor Tony Walker. To ask Tony a question or to find an advisor in your area, log on to TonyWalkerFinancial.com.